disadvantages of Reg D, I've touched on a couple. Investors tend to be skeptical. Most Reg D investors, that by definition, they're already millionaires. Many of them have burned their fingers, as I have. So they're more savvy. They're more difficult to reach because they have a bazillion options. So many companies are raising money and providing them accredited investors opportunities to invest that it's harder to get their attention. For the issuer company, you guys are probably, most all of you are probably issuers, you will get a lower valuation raising money in a Reg D from accredited investors typically than you would via a Reg A plus. The Reg A plus is a public offering with restrictions that go along with that, but you can generally get a higher valuation in that offering. And the accreditation verification step that I already mentioned, that's something which will irritate some people or put them off online investing. Advantages of Reg D, you're allowed to make projections. Unlike in a Reg A plus or an S1 IPO, where we have to protect the investors from naive or greedy founders. I'm going to close the door for a minute because my dog is barking. So unlike in a Reg A plus, where we have to provide a great deal more protection, in a Reg D offering, you're allowed to make a projected internal rate of return statement. You're allowed to project how many buildings you intend to buy or how many acquisitions you might accomplish, you intend to accomplish over a period of time, depending what it is that your business plan is. Those types of projections are a luxury that you get because the SEC says, they don't say this to me, the SEC's behavior indicates that they consider accredited investors to be sophisticated enough that they don't need to be so protected. They can interpret and with the right degree of skepticism the statements and claims that you are making in your Reg D offering. Another advantage is you don't need audited financials in a Reg D. The process of filing with the SEC is very simple. You don't file and ask for feedback. You don't expect any response from the SEC. You're supposed to file a Form D offering within 30 days of accepting your first investment. So it's very, very relaxed. That's not a remarkably demanding thing. But the SEC then obviously reserves the right to audit, that is to say, to check your filing at any time in the future and compare it to what you're doing and make sure that what you're doing is legitimate. But it's a heck of a lot simpler than an S1 IPO or a Reg A plus filing, for example. I would say the marketing restrictions in Reg D offerings 506C are very straightforward. You're not allowed to make hyperbolic kind of statements. You can't say we are revolutionizing the entire AI chip business. You can't make grandiose claims like that. What you say has to be based on fact and be reasonable, but you are allowed to do broad-based marketing via advertising vehicles online, and I think it's pretty straightforward. Frankly, I don't think the SEC's restrictions are unreasonable. The legal filing documents are a lot less expensive than an S1 IPO or a Reg A plus. A PPM is required, private placement memorandum. It has other, people call it other things, but this is a document that provides extensive risk factors in it to warn the investor and to reduce the risk of future lawsuits. It also describes the terms of the offering, and it's essentially a statement of credibility for the company. It states what the business is, it states who the principals are, what the terms of the offering are, etc., etc. And that's less expensive by far than some of the other capital raising methods. Reg D, is widely known and accepted. The last time I checked, there was something like $6 billion a year being raised by Reg D, and that probably severely understates how much money is raised. You are allowed to provide investor optionality. For example, you're doing a real estate project and you will offer the option at the 3 and 5 year points for investors to redeem their investment with whatever gains that they have accumulated, or to stay on board and reinvest. That optionality is a very powerful thing which you have in Reg D that you don't have in a Reg A plus or an S1, for example. And you can use more sophisticated instruments in a Reg D, which you could probably use in other methods, but they don't work so well. So because the investors in a Reg D offering are accredited, more sophisticated, you can offer things like warrants that might confuse investors in a public offering, in a Reg D offering, sorry, or in a Reg A plus offering.